income taxes everywhere. Opposition is always at its most reckless and strident at the very outset. With every year that passes, the tax tends to become stronger and the voices of its enemies more muted. Britain's income tax was repealed the year after the victory at Waterloo, was revived in a half-hearted way in 1832, was sponsored with enthusiasm by Sir Robert Peel a decade later, and remained in effect thereafter. The basic rate during the second half of the 19th century varied between 5% and less than 1%, and it was only 2.5% with a modest surtax on high incomes as late as 1913. The American idea of very high rates on high incomes eventually caught on in Britain, though, and by the middle 1960s, the top British bracket was over 90%. Elsewhere in the world, or at least in the economically developed world, country after country took the cue from Britain and instituted an income tax at one time or another during the 19th century. Post-revolutionary France soon enacted an income tax, but then repealed it and managed to get along without one for a number of years in the second half of the century. Eventually, though, the loss of revenue proved to be intolerable, and the tax returned to become a fixture of the French economy. An income tax was one of the first, if not one of the sweetest fruits of Italian unity. While several of the separate states that were to combine into the German nation had income taxes even before they were united. By 1911, income taxes also existed in Austria, Spain, Belgium, Sweden, Norway, Denmark, Switzerland, Holland, Greece, Luxembourg, Finland, Australia, New Zealand, Japan, and India. As for the United States, the enormous size of whose income tax collections and the apparent docility of whose taxpayers are now the envy of governments everywhere, it was a laggard in the matter of instituting an income tax and for years was an inveterate backslider in the matter of keeping one on its statute books. It is true that in colonial times there were various revenue systems bearing some slight resemblance to income taxes. In Rhode Island at one point, for example, each citizen was supposed to guess the financial status of 10 of his neighbors in regard to both income and property in order to provide a basis for tax assessments. But such schemes, being inefficient and subject to obvious opportunities for abuse, were short-lived. The first man to propose a federal income tax was President Madison's Secretary of the Treasury, Alexander J.S. Dallas. He did so in 1814, but a few months later the War of 1812 ended. The demand for government revenue eased, and the Secretary was hooted down so decisively that the subject was not revived until the time of the Civil War, when both the Union and the Confederacy enacted income tax bills. Before 1900, very few new income taxes appear to have been enacted anywhere without the stimulus of a war. National income taxes were, and until quite recently largely remained, war and defense measures. In June of 1862, prodded by public concern over a public debt that was increasing at the rate of $2 million a day, Congress reluctantly passed a law providing for an income tax at progressive rates up to a maximum of 10%, and on July 1st, President Lincoln signed it in law, along with a bill to punish the practice of polygamy. The next day, stocks on the New York Exchange took a dive, which was probably not attributable to the polygamy bill. I am taxed on my income. This is perfectly gorgeous. I never felt so important in my life before, Mark Twain wrote in the Virginia City, Nevada Territorial Enterprise after he had paid his first income tax bill for the year 1864. $36.82, including a penalty of $3.12 for being late. Although few other taxpayers were so enthusiastic, the law remained in force until 1872. It was, however, subjected to a succession of rate reductions and amendments, one of them being the elimination, in 1865, of its progressive rates on the arresting ground that collecting 10% on high incomes and lower rates on lower incomes constituted undue discrimination against wealth. Annual revenue collections mounted from $2 million in 1863 to $73 million in 1866, and then descended sharply. For 2 decades, beginning in the early 1870s, the very thought of an income tax did not enter the American mind. Apart from rare occasions when some populist or socialist agitator would propose the establishment of such a tax designed specifically to soak the urban rich. Then, in 1893, when it had become clear that the country was relying on an obsolete revenue system that put too little burden on businessmen and members of the professions, President Cleveland proposed an income tax. The outcry that followed was shrill. Senator John Sherman of Ohio, the father of the Sherman Antitrust Act, called the proposal socialism, communism, and devilism, and another senator spoke darkly of the professors with their books, the socialists with their schemes, and the anarchists with their bombs, while over in the House a congressman from Pennsylvania laid his cards on the table in the following terms: an income tax. A tax so odious that no administration ever dared to impose it except in time of war. It is unutterably distasteful, both in its morale and material aspects. It does not belong to a free country. It is class legislation. Do you desire to offer a reward to dishonesty and to encourage perjury? The imposition of the tax will corrupt the people. It will bring in its train the spy and the informer. It will necessitate a swarm of officials with inquisitorial powers. Mr. Chairman, pass this bill and the Democratic Party signs its death warrant. The proposal that gave rise to these fulminations was for a tax at a uniform rate of 2% on income in excess of $4,000, and it was enacted into law in 1894. The Democratic Party survived, but the new law did not. Before it could be put into force, it was thrown out by the Supreme Court, on the ground that it violated the constitutional provision forbidding direct taxes unless they were apportioned among the states according to population. Curiously, this point had not been raised in connection with the Civil War income tax, and the income tax issue was dead again, this time for a decade and a half. In 1909, by what a tax authority named Jerome Hellerstein has called one of the most ironic twists of political events in American history, the constitutional amendment, the 16th, that eventually gave Congress the power to levy taxes without apportionment among the states, was put forward by the implacable opponents of the income tax. The Republicans, who took the step as a political move, would never be ratified by the states. To their dismay, it was ratified in 1913, and later that year, Congress enacted a graduated tax on individuals at rates ranging from 1% to 7%, and also a flat tax of 1% on the net profits of corporations. The income tax has been with us ever since. By and large, its history since 1913 has been one of rising rates and of the seasonable appearance of special provisions to save people in the upper brackets from the inconvenience of having to pay those rates. The first sharp rise took place during the First World War, and by 1918, the bottom rate was 6% and the top one, applicable to taxable income in excess of $1 million, was 77%, or far more than any government had previously ventured to exact on income of any amount. But the end of the war and the return to normalcy brought a reversal of the trend, and there followed an era of low taxes for rich and poor alike. Rates were reduced by degrees until 1925, when the standard rate scale ran from 1.5% to an absolute top of 25%. And furthermore, a great majority of the country's wage earners were relieved of paying any tax at all by being allowed personal exemptions of $1,500 for a single person, $3,500 for a married couple, and $400 for each dependent. This was not the whole story, for it was during the 20s that special interest provisions began to appear, stimulated into being by the complex of political forces that has accounted for their increase at intervals ever since. The first important one, adopted in 1922, established the principle of favored treatment for capital gains. This meant that money acquired through a rise in the value of investments was, for the first time, taxed at a lower rate than money earned in wages or for services, as of course it still is today. Then in 1926 came the loophole that has undoubtedly caused more gnashing of teeth among those not in a position to profit by it than any other: the percentage depletion allowance on petroleum, which permits the owner of a producing oil well to deduct from his taxable income up to 27.5% up to 27.5% off his gross annual income from the well, and to keep deducting that much year after year, even though he has deducted the original cost of the well many times over. Whether or not the 20s were a golden age for the American people in general, they were assuredly a golden age for the American taxpayer. The Depression and the New Deal brought with them a trend toward higher tax rates and lower exemptions, which led up to a truly revolutionary era in federal income taxation, that of the Second World War. By 1936, largely because of greatly increased public spending, rates in the higher brackets were roughly double what they had been in the late 20s, and the very top bracket was 79%, while at the low end of the scale, personal exemptions had been reduced to the point where a single person was required to pay a small tax, even if his income was only $1,200. As a matter of fact, at that time, most industrial workers' incomes did not exceed $1,200. In 1944 and 1945, the rate scale for individuals reached its historic peak, 23% at the low end and 94% at the high one, while income taxes on corporations, which had been creeping up gradually from the original 1913 rate of 1%, reached the point where some companies were liable for 80%. But the revolutionary thing about wartime taxation was not the very high rates on high incomes. Indeed, in 1942, when this upward surge was approaching full flood, a new means of escape for high-bracket taxpayers appeared, or an old one widened for the period during which stocks or other assets must be held in order to benefit from the capital. Gains provision was reduced from 18 months to 6. What was revolutionary was the rise of industrial wages and the extension of substantial tax rates to the wage earner, making him, for the first time, an important contributor to government revenue. Abruptly, the income tax became a mass tax, and so it has remained. Although taxes on big and middle-sized businesses settled down to a flat rate of 52%, rates on individual income did not change significantly between 1945 and 1964. That is to say, the basic rates did not change significantly. There were temporary remissions amounting to anywhere from 5% to 17% of the sums due under the basic rates. During the years 1946 through 1950, the range was from 20% to 91% until 1950. There was a small rise during the Korean War, but it went right back there in 1954. In 1950, another important escape route, the so-called restricted stock option, opened up, enabling some corporate executives to be taxed on part of their compensation at low capital gains rates. The significant change, invisible in the rate schedule, has been a continuation of the one begun in wartime, namely the increase in the proportionate tax burden carried by the middle and lower income groups. Paradoxical as it may seem, the evolution of our income tax has been from a low-rate tax relying for revenue on the high-income group to a high-rate tax relying on the middle and lower middle-income groups. The Civil War levy, which affected only 1% of the population, was unmistakably a rich man's tax, and the same was true of the 1913 levy. Even in 1918, at the height of the budget squeeze produced by the First World War, less than 4.5 million Americans, of a total population of more than 100 million, had to file income tax returns at all. In 1933, in the depths of the Depression, only 3.75 million returns were filed, and in 1939, an elite consisting of 700,000 taxpayers, of a population of 130 million, accounted for 9/10 of all income tax collections, while in 1960 it took some 32 million taxpayers, something over 1/6 of the population, to account for 9/10 of all collections, and a whopping big 9/10 it was, totaling some $35.5 billion compared to less than $1 billion in 1939. The historian Seligman wrote in 1911 that the history of income taxation the world over consisted essentially of evolution toward basing it on ability to pay. One wonders what qualifications he might add on the basis of the American experience since then if he were still alive. Of course, one reason people with middle incomes pay far more in taxes than they used to is that there are far more of them. Changes in the country's social and economic structure have been as big a factor in the shift as the structure of the income tax has. It remains probable, though, that, in actual practice, the aboriginal income tax of 1913 extracted money from citizens with stricter regard to their ability to pay than the present income tax does. Whatever the faults of our income tax law, it is beyond question the best. Obeyed income tax law in the world, and income taxes are now ubiquitous from the Orient to the Occident and from pole to pole. Practically all of the dozens of new nations that have come into being over the past few years have adopted income tax measures. Walter H. Diamond, the editor of a publication called Foreign Tax Trade Briefs, has noted that as recently as 1955 he could rattle off the names of 24 countries, large and small, that did not tax the individual, but that in 1965 the only names he could rattle off were those of a couple of British colonies, Bermuda and the Bahamas, a couple of tiny republics, San Marino and Andorra, 3 oil-rich Middle Eastern countries, the Sultanate of Muscat and Oman, Kuwait and Kuwait, and 2 rather inhospitable countries, Monaco and Saudi Arabia, which tax the incomes of resident foreigners but not those of nationals. Even communist countries have income taxes, though they count on them for only a small percentage of their total revenue. Russia applies different rates to different occupations, shopkeepers and ecclesiastics being in the high tax bracket, artists and writers near the middle, and laborers and artisans at the bottom. Evidence of the superior efficiency of tax collecting in the United States is plentiful. For instance, our costs for administration and enforcement come to only about 44 cents for every $100 collected, as against a rate more than twice as high in Canada, more than 3 times high in England, France, and Belgium, and many times as high in other places. This kind of American efficiency is the despair of foreign tax collectors. Toward the end of his term in office, Mortimer M. Kaplan, who was Commissioner of Internal Revenue from January 1961 until July 1964, held consultations with the leading tax administrators of 6 Western European countries. And the question heard again and again was, how do you do it? Do they like to pay taxes over there? Of course, they do not. But as Kaplan said at the time, we have a lot going for us that the Europeans haven't. One thing we have going for us is tradition. American income taxes originated and developed not as a result of the efforts of monarchs to fill their coffers at the expense of their subjects, but as a result of the efforts of an elected government to serve the general interest. A widely traveled tax lawyer observed not long ago, in most countries, it's impossible to engage in a serious discussion of income taxes because they aren't taken seriously. They're taken seriously. They are taken serious. Here, and part of the reason, is the power and skill of our income tax police force, the Internal Revenue Service. Unquestionably, the swarm of officials feared by the Pennsylvania congressman in 1894 has come into being. And there are those who would add that the officials have the inquisitorial powers he also feared. As of the beginning of 1965, the Internal Revenue Service had approximately 60,000 employees, including more than 6,000 revenue officers and more than 12,000 revenue agents. And these 18,000 men possessing the right to inquire into every penny of everyone's income and into matters like exactly what was discussed at an expense, account meal, and armed with the threat of heavy punishments, have powers that might reasonably be called inquisitorial. But the IRS engages in many activities besides actual tax collecting, and some of these suggest that it exercises its despotic powers in an equitable way, if not actually in a benevolent one. Notable among the additional activities is a taxpayer education program on a scale that occasionally inspires an official to boast that the IRS runs the largest university in the world. As part of this program, it puts out dozens of publications explicating various aspects of the law, and it is proud of the fact that the most general of these, a blue-covered pamphlet entitled Your Federal Income Tax, which is issued annually and in 1965 could be bought for 40 cents at any district director's office, is so popular that it is often reprinted by private publishers who sell it to the unwary for $1 or more, pointing out with triumphant accuracy that it is an official government publication. Since government publications are not copyrighted, this is perfectly legal. The IRS also conducts institutes on technical questions every December for the enlightenment of the vast core of tax practitioners, accountants and lawyers, who will shortly be preparing the returns of individuals and corporations. It puts out elementary tax manuals designed specially for free distribution to any high schools that ask for them. And according to one IRS official, some 85% of American high schools did ask for them in one recent year. The question of whether school children ought to be spending their time boning up on the tax laws is one that the IRS considers to be outside its scope. Furthermore, just before the tax deadline each year, the IRS customarily goes on television with spot advertisements offering tax pointers and reminders. It is proud to say that of the various spots, a clear majority have been in the interests of protecting taxpayers from overpaying. In the fall of 1963, the IRS took a big step toward increasing the efficiency of its collections still further, and by a feat worthy of the wolf in Little Red Riding Hood, it managed to present the step to the public as a grandmotherly move to help everybody out. The step was the establishment of a so-called national identity file involving the assignment to every taxpayer of an account number, usually his social security number, and its intention was to practically eliminate the problem created by people who failed to declare their income from corporate dividends or from interest on bank accounts or bonds, a form of evasion that was thought to have been costing the Treasury hundreds of millions a year. But that is not all. When the number is entered in the proper place on a return, this will make certain that you are given immediate credit for taxes reported and paid by you, and that any refund will be promptly recorded in your favor. So Commissioner Kaplan commented brightly on the front cover of the 1964 Tax Return Forms. The IRS then began taking another giant step, the adoption of a system for automating a large part of the tax checking process, in which 7 regional computers would collect and collate data that would be fed into a master data processing center at Martinsburg, West Virginia. This installation, designed to make 250,000 number comparisons per second, began to be called the Martinsburg Monster, even before it was in full operation. In 1965, between 4 and 5 million returns a year were given a complete audit, and all returns were checked for mathematical errors. Some of this mathematical work was being done by computers and some by people, but by 1967, when the computer system was going full blast, all the mathematical work was done by machine, thus freeing many IRS employees to subject even more returns to detailed audits, according to a publication authorized by the IRS. Back in 1963, though, the capacity and memory of the computer system will help taxpayers who forget prior year credits or who do not take full advantage of their rights under the laws. In short, it was going to be a friendly monster. If the mask that the IRS had presented to the country in recent years has worn a rather ghastly expression of benignity, part of the explanation is probably nothing more sinister than the fact that Kaplan, the man who dominated it in those years, is a cheerful extrovert and a natural politician, and that his influence continued to be felt under the man who was appointed to succeed him as commissioner in December 1964, a young Washington lawyer named Sheldon S. Cohen, who took over the job after a 6-month interim during which an IRS careerman named Bertrand M. Harding served as acting commissioner. When Kaplan resigned as commissioner, he stepped out of politics, at least temporarily, returning to his Washington law practice as a specialist in, among other things, the tax problems of businessmen. Kaplan is widely considered to have been one of the best commissioners of internal revenue in history, and at the very least, he was certainly an improvement on 2 fairly recent occupants of the post, one of whom, sometime after leaving it, was convicted and sentenced to 2 years in prison for evading his own income taxes, and the other of whom subsequently ran for public office on a platform of opposition to any federal income tax, as a former umpire might stump the country against baseball. Among the accomplishments that Mortimer Kaplan, a small, quick-spoken, dynamic man who grew up in New York City and used to be a University of Virginia law professor, is credited with as commissioner is the abolition of the practice that had previously been alleged to exist of assigning collection quotas to IRS agents. He gave the top echelons of IACRS an air of integrity beyond cavil, and, what was perhaps most striking, managed the strange feat of projecting to the nation a sort of enthusiasm for taxes considered abstractly. Thus he managed to collect them with a certain style, a sort of subsidiary new frontier, which he called the New Direction. The chief thrust of the New Direction was to put increased emphasis on education leading toward increased voluntary compliance with the tax law, instead of concentrating on the search for and prosecution of conscious offenders. In a manifesto that Kaplan issued to his swarm of officials in the spring of 1961, he wrote, "We all should understand that the service is not simply running a direct enforcement business aimed at making $2 billion in additional assessments, collecting another billion from delinquent accounts, and prosecuting a few hundred evaders. Rather, it is charged with administering an enormous self-assessment tax system, which raises over $90 billion from what people themselves put down on their tax returns and voluntarily pay, with another $2 or $3 billion coming from direct enforcement activities. In short, we cannot forget that 97% of our total revenue comes from self-assessment or voluntary compliance, with only 3% coming directly from enforcement. Our chief mission is to encourage and achieve more effective voluntary compliance. The New Direction is really a shift in emphasis, but it is a very important shift. It may be, though, that the true spirit of the New Direction is better epitomized on the jacket of a book entitled The American Way in Taxation, edited by Lillian Doris, which was published in 1963 with the blessing of Kaplan, who wrote the foreword. Here is the exciting story of the largest and most efficient tax collecting organization the world has ever known, the United States Internal Revenue Service. The jacket announced, in part, here are the stirring events, the bitterly fought legislative battles, the dedicated civil servants that have marched through the past century and left an indelible imprint on our nation. You'll thrill to the epic legal battle to kill the income tax, and you'll be astonished at the future plans of the IRS. You'll see how giant computers, now on the drawing boards, are going to affect the tax collection system and influence the lives of many American men and women in new and unusual ways. It sounded a bit like a circus barker hawking a public execution. It is debatable whether the new direction watchword of voluntary compliance could properly be used to describe a system of tax collection under which some 3/4 of all collections from individuals are obtained through withholding at the source, under which the IRS and its Martinsburg monster lurk to catch the unwary evader, and under which the punishment for evasion runs up to 5 years in prison per offense, in addition to extremely heavy financial penalties. Kaplan, however, did not seem to feel a bit of concern over this point. With tireless good humor, he made the rounds of the nation's organizations of businessmen, accountants, and lawyers, giving luncheon talks in which he praised them for their voluntary compliance in the past, exhorted them to greater efforts in the future, and assured them that it was all in a good cause. We're still striving for the human touch in our tax administration, declared the essay on the cover of the 1964 tax return forms, which Kaplan signed, in which he says he composed in collaboration with his wife. I see a lot of humor in this job, he told a caller a few hours after remarking to a luncheon meeting of the Kiwanis Club of Washington at the Mayflower Hotel. Last year was the 50th anniversary of the income tax amendment to the Constitution, but the Internal Revenue Service somehow or other didn't seem to get any birthday cakes. This might perhaps be considered a form of gallows humor, except that the hangman is not supposed to be the one who makes the jokes. Cohen, the commissioner who succeeded Kaplan and was still in office in mid-1968, is a born and bred Washingtonian who, in 1952, graduated from George Washington University Law School at the top of his class, served in a junior capacity with the IRC for the next 4 years, practiced law in Washington for 7 years after that, eventually becoming a partner in the celebrated firm of Arnold Fortis Porter. At the beginning of 1964, returned to the IRS as its chief counsel, and a year later, at the age of 37, became the youngest Commissioner of Internal Revenue in history, a man with close-cropped brown hair, candid eyes, and a guileless manner that makes him seem even younger than he is. Cohen came from the chief counsel's office with the reputation of having uplifted it both practically and philosophically. He was responsible for an administrative reorganization that has been widely praised as making faster decisions possible, and for a demand that the IRS be consistent in its legal stand in cases against taxpayers, that it refrain from taking one position on a fine point of code interpretation in Philadelphia, say, and the opposite position on the same point in Omaha, which is considered a triumph of high principle over governmental greed. In general, Cohen said upon assuming office, he intended to continue Kaplan's policies, to emphasize voluntary compliance, to strive for agreeable, or at least not disagreeable, relations with the tax-paying public, and so on. He is a less gregarious and a more reflective man than Kaplan, however, and this difference has had its effect on the IRS as a whole. He has stuck relatively close to his desk, leaving the luncheon circuit pep talks to subordinates. Mort was wonderful at that sort of thing, Cohen said in 1965. Public opinion of the service is high now as a result of his big push in that direction. We want to keep it high without more pushing on my part. Anyhow, I couldn't do it well. I'm not made that way. A charge that has often been made and continues to be made is that the office of commissioner carries with it far too much power. The commissioner has no authority to propose changes in rates or initiate other new tax legislation. The authority to propose rate changes belongs to the Secretary of the Treasury, who may or may not seek the commissioner's advice in the matter, and the enactment of new tax laws is, of course, the job of Congress and the President. But tax laws, since they must cover so many different situations, are necessarily written in rather general terms, and the commissioner is solely responsible, subject to reversal in the courts, for writing the regulations that are supposed to explain the laws in detail. And sometimes the regulations are a bit cloudy themselves, and in such cases, who is better qualified to explain them than their author? The commissioner? Thus, it comes about that almost every word that drops from the commissioner's mouth, whether at his desk or at luncheon meetings, is immediately distributed by the various tax publishing services to tax accountants and lawyers all over the country and is gobbled up by them with an avidity not always accorded the remarks of an appointed official. Because of this, some people see the commissioner as a virtual tyrant. Others, including both theoretical and practical tax experts, disagree. Jerome Hellerstein, who is a law professor at New York University Law School as well as a tax advisor, says the latitude of action given the commissioner is great. And it's true that he can do things that may affect the economic development of the country as well as the fortunes of individuals and corporations. But if he had small freedom of action, it would result in rigidity and certainty of interpretation, and would make it much easier for tax practitioners like me to manipulate the law to their clients' advantage. The commissioner's latitude gives him a healthy unpredictability. Certainly, Kaplan did not knowingly abuse his power, nor has Cohen done so. Upon visiting first one man and then the other in the commissioner's office, I found that both conveyed the impression of being men of high intelligence who were living as Arthur M. Intelligence, who were living. Schlesinger Jr. has said that Thoreau lived at a high degree of moral tension, and the cause of the moral tension is not hard to find. It almost surely stemmed from the difficulty of presiding over compliance, voluntary or involuntary, with a law of which one does not very heartily approve. In 1958, when Kaplan appeared as a witness versed in tax matters rather than as Commissioner of Internal Revenue, before the House Ways and Means Committee, he proposed an across-the-board program of reforms, including, among other things, either the total elimination or a drastic curbing of favored treatment for capital gains, the lowering of percentage depletion rates on petroleum and other minerals, the withholding of taxes on dividends and interest, and the eventual drafting of an entirely new income tax law to replace the 1954 code, which he declared had led to hardships, complexities, and opportunities for tax avoidance. Shortly after Kaplan left office, he explained in detail what his ideal tax law would be like. Compared to the present tax law, it would be heroically simple, with loopholes eliminated and most personal deductions and exemptions eliminated too, and with a rate scale ranging from 10 to 50%. In Kaplan's case, the resolution of moral tension, insofar as he achieved it, was not entirely the result of rational analysis. Some critics take a completely cynical view of the income tax, he mused one day during his stint as commissioner. They say, in effect, it's a mess, and nothing can be done about it. I can't go along with that. True, many compromises are necessary, and will continue to be, but I refuse to accept a defeatist attitude. There's a mystic quality about our tax system. No matter how bad it may be from the technical standpoint, it has a vitality because of the very high level of compliance. He paused for quite a long time, perhaps finding a flaw in his own argument. In the past, after all, universal compliance with a law has not always been a sign that it was either intelligent or just. Then he went on, looking over the sweep of years. I think we'll come out well. Probably a point of crisis of some kind will make us begin to see beyond selfish interests. I'm optimistic that 50 years from now, we'll have a pretty good tax. As for Cohen, he was working in the legislation, drafting section of the IRS at the time the present code was written, and he had a hand in its composition. One might suppose that this fact would cause him to have a certain proprietary feeling toward it, but apparently that is not so. Remember that we had a Republican administration then, and I'm a Democrat, he said one day in 1965. When you're drafting a statute, you operate as a technician. Any pride you may feel afterward is pride in technical competence. So Cohen can reread his old prose, now enshrined as law, with neither elation nor remorse. And he has not the slightest hesitation about endorsing Kaplan's opinion that the code leads to hardships, complexities, and opportunities for tax avoidance. He is more pessimistic than Kaplan about finding the answer in simplification. Perhaps we can move the rates down and get rid of some deductions, he says. But then we may find we need new deductions in the interests of fairness. I suspect that a complex society requires a complex tax law. If we put in a simpler code, it would probably be complex again in a few years. Every nation has the government it deserves. The French writer and diplomat Joseph de Maistre declared in 1811. Since the primary function of government is to make laws, the statement implies that every nation has the laws it deserves. And if the doctrine may be considered at best a half-truth in the case of governments that exist by force, It does seem persuasive in the case of governments that exist by popular consent. If the single most important law now on the statute books of the United States is the income tax law, it would follow that we must have the income tax law we deserve. Much of the voluminous discussion of the income tax law in recent years has centered on plain violations of it, among them the deliberate padding of tax, deductible business, expense accounts, the matter of taxable income that is left undeclared on tax returns, fraudulently or otherwise, some estimated at as high as $25 billion a year, and the matter of corruption within the ranks of the Internal Revenue Service, which some authorities believe to be fairly common, at least in large cities. Such forms of outlawry, of course, reflect timeless and worldwide human frailties. The law itself, however, has certain characteristics that are more closely related to a particular time and place, and if de Maistre was right, these should reflect national characteristics. The income tax law, that is, should be to some extent a national mirror. How does the reflection look? To repeat then, the basic law under which income taxes are now imposed is the Internal Revenue Code of 1954, as amplified by innumerable regulations issued by the Internal Revenue Service, interpreted by innumerable judicial decisions, and amended by several acts of Congress, including the Revenue Act of 1964, which embodied the biggest tax cut in our history. The Code, a document longer than War and Peace, is phrased, inevitably perhaps, in the sort of jargon that stuns the mind and disheartens the spirit. A fairly typical sentence dealing with the definition of the word employment starts near the bottom of page 564, includes more than 1,000 words, 19 semicolons, 42 simple parentheses, 3 parentheses within parentheses within parentheses, and even one unaccountable interstitial period, and comes to a gasping end with a definitive period near the top of page 567. Not until one has penetrated to the part of the code dealing with import taxes, which fall within its province, along with estate taxes and various other federal imposts, does one come upon a comprehensible and diverting sentence like every person who shall export oleomargarine shall brand upon every tub, firkin, or other package containing such article the word oleomargarine in plain Roman letters not less than 1/2 inch square. Yet a clause on page 2 of the code, though it is not a sentence at all, is as clear and forthright as one could wish. It sets forth without ado the rates at which the incomes of single individuals are to be taxed. 20% on taxable income of not over $2,000, 22% on taxable income of not over $2,000, 22% on taxable income of over $2,000 but not over $4,000. And so on, up to a top rate of 91% on taxable income of over $200,000. As we have seen, the rates were amended downward in 1964 to a top of 70%. Right at the start, then, the code makes its declaration of principle, and to judge by the rate table, it is implacably egalitarian, taxing the poor relatively egalitarian, taxing the poor relatively lightly, and the very rich at levels that verge on the confiscatory. But to repeat a point that has become so well known that it scarcely needs repeating, the code does not live up to its principles very well. For proof of this, one need look no further than some of the recent score sheets of the income tax, a set of volumes entitled Statistics of Income, which are published annually by the Internal Revenue Service. For 1960, individuals with gross incomes of between $4,000 and $5,000, after taking advantage of all their deductions and personal exemptions, and availing themselves of the provision that allows married couples and the heads of households to be taxed at rates generally lower than those for single persons, ended up paying an average tax bill of about 1/10 of their reportable receipts, while those in the $10,000, $15,000 range paid a bill of about 1/7 those in the $25,000. $50,000 range paid a bill of not quite a quarter, and those in the $50,000 range paid a bill of not quite a quarter, and those in the $50,000 range paid a bill about a third. Up to this point, clearly, we find a progression according to ability to pay, much as the rate table prescribes. However, the progression stops abruptly when we reach the top income brackets. That is, at just the point where it is supposed to become most marked. For 1960, the $150,000, $200,000, $200,000, $500,000, $500,000, $1 million, and million, plus groups each paid on the average less than 50% of their reportable incomes. And when one takes into consideration the fact that the richer a man is, the likelier it is that a huge proportion of have money need not even be reported as gross taxable income. All income from certain bonds, for example, and half of all income from long-term capital gains. It becomes evident that at the very top of the income scale, the percentage rate of actual taxation turns downward. The evidence is confirmed by the Statistics of Income for 1961, which breaks down figures on payments according to bracket, and which shows that although 7,487 taxpayers declared gross incomes of $200,000 or more, fewer than 500 of them had net income that was taxed at the rate of 91%. Throughout its life, the rate of 91% was a public tranquilizer, making everyone in the lower bracket feel fortunate not to be rich and not hurting the rich very much. And then, to top off the joke, if that is what it is, there are the people with more income than anyone else who pay less tax than anyone else. That is, those with annual incomes of $1 million or more who manage to find perfectly legal ways of paying no income tax at all. According to Statistics of Income, there were 11 of them in 1960, out of a national total of 306 million a year men and 17 in 1961, out of a total of 398. In plain fact, the income tax is hardly progressive at all. The explanation of this disparity between appearance and reality, so huge that it lays the code open to a broad accusation of hypocrisy, is to be found in the detailed exceptions to the standard rates which lurk in its dim depths. Exceptions that are usually called special interest provisions or, more bluntly, loopholes. As all fair-minded users of the word are ready to admit, is a somewhat subjective designation. For one man's loophole may be another man's lifeline, or perhaps at some other time, the same man's lifeline. Loopholes were noticeably absent from the original 1913 income tax law. How they came to be law and why they remain law are questions involving politics and possibly metaphysics, but their actual workings are relatively simple and are illuminating to watch. By far the simplest method of avoiding income taxes, at least for someone who has a large amount of capital at his disposal, is to invest in the bonds of states, municipalities, port authorities, and toll roads. The interest paid on all such bonds is unequivocally tax-exempt. Since the interest on high-grade tax-exempt bonds in recent years has run from 3 to 5%, a man who invests $10 million in them can collect $300,000 to $500,000 to $500,000 a year, tax-free without putting himself or his tax lawyer to the slightest trouble. If he had been foolish enough to sink the money in ordinary investments yielding, say, 5%, he would have had a taxable income of $500,000. And at the 1964 rate, assuming that he was single, had no other income, and did not avail himself of any dodges, he would have to pay taxes of almost $367,000. The exemption on state and municipal bonds has been part of our income tax law since its beginnings. It was based originally on constitutional grounds, and is now defended on the ground that the states and towns need the money. Most secretaries of the Treasury have looked on the exemption with disfavor, but not one has been able to accomplish its repeal. Probably the most important special interest provision in the code is the one that concerns capital gain. The staff of the Joint Economic Committee of Congress wrote in a report issued in 1961, capital gains treatment has become one of the most impressive loopholes in the federal revenue structure. What the provision says, in essence, is that a taxpayer who makes a capital investment in real estate, a corporation, a block of stock, or whatever, holds on to it for at least 6 months, and then sells it at a profit, is entitled to be taxed on the profit at a rate much lower than the rate on ordinary income. To be specific, the rate is half of that taxpayer's ordinary top tax rate, or 25%, whichever is less. What this means to anyone whose income would normally put him in a very high tax bracket is obvious. He must find a way of getting as much as possible of that income in the form of capital gains. Consequently, the game of finding ways of converting ordinary income into capital gains has become very popular in the past decade or two. The game is often won without much of a struggle. On television one evening in the middle 1960s, David Susskind asked 6 assembled multimillionaires whether any of them considered tax rates a stumbling block on the highway to wealth in America. There was a long silence, almost as if the notion were new to the multimillionaires. And then one of them, in the tone of someone explaining something to a child, mentioned the capital gains provision and said that he didn't consider taxes much of a problem. There was no more discussion of high tax rates that night. If the capital gains provision resembles the exemption on certain bonds and that the advantages it affords are of benefit chiefly to the rich, it differs in other ways. It is by far the more accommodating of the two loopholes. Indeed, it is a sort of mother loophole capable of spawning other loopholes. For example, one might think that a taxpayer would need to have capital before he could have a capital gain. Yet a way was discovered and was passed into law in 1950 for him to get the gain before he has the capital. This is the stock option provision. Under its terms, a corporation may give its executives the right to buy its shares at any time within a stipulated period, say 5 years, at or near the open market price at the time of the granting of the option. Later on, if, as has happened so often, the market price of the stock goes sky high, the executives may exercise their options to buy the stock at the old price, may sell it on the open market sometime later at the new price, and may pay only capital gains rates on the difference, provided that they go through these motions without unseemly haste. The beauty of it all from an executive's point of view is that once the stock has gone up substantially in value, his option itself becomes a valuable commodity, against which he can borrow the cash he needs in order to exercise it. Then, having bought the stock and sold it again, he can pay off his debt and have a capital gain that has arisen from the investment of no capital. The beauty of it all from the corporation's point of view is that they can compensate their executives partly in money taxable at relatively low rate. Of course, the whole scheme comes to nothing if the company's stock goes down, which does happen occasionally, or if it simply doesn't go up. But even then, the executive has had a free play on the roulette wheel of the stock market, with a chance of winning a great deal and practically no danger of losing anything, something that the tax law offers no other group. By favoring capital gains over ordinary income, the code seems to be putting forward two very dubious notions: that one form of unearned income is more deserving than any form of earned income, and that people with money to invest are more deserving than people without it. Hardly anyone contends that the favored treatment of capital gains can be justified on the ground of fairness. Those who consider this aspect of the matter are apt to agree with Hellerstein, who has written, from a sociological viewpoint, there is a good deal to be said for more severe taxation of profit from appreciation in the value of property than from personal service income. The defense, then, is based on other grounds. For one, there is a respectable economic theory that supports a complete exemption of capital gains from income tax. The argument being that whereas wages and dividends or interest from investments are fruits of the capital tree and are therefore taxable income, capital gains represent the growth of the tree itself and are therefore not income at all. This distinction is actually embedded in the tax laws of some countries, most notably in the tax law of Britain, which in principle did not tax capital gains until 1964. Another argument, this one purely pragmatic, has it that the capital gains provision is necessary to encourage people to take risks with their capital. Similarly, the advocates of stock options say that corporations need them to attract and hold executive talent. Finally, nearly all tax authorities are agreed that taxing capital gains on exactly the same basis as other income, which is what most reformers say ought to be done, would involve formidable technical difficulties. Particular subcategories of the rich and the well-paid can avail themselves of various other avenues of escape, including corporate pension plans, which, like stock options, contribute to the solution of the tax problems of executives. Tax-free foundations set up ostensibly for charitable and educational purposes, of which over 15,000 help to ease the tax burdens of their benefactors, though the charitable and educational activities of some of them are more or less invisible. And personal holding companies, which subject to rather strict regulations, enable persons with very high incomes from personal services like writing and acting to reduce their taxes by what amounts to incorporating themselves. Of the whole array of loopholes in the code, however, probably the most widely loathed is the percentage depletion allowance on oil. As the word depletion is used in the code, it refers to the progressive exhaustion of irreplaceable natural resources. But as used on oilmen's tax returns, it proves to mean a miraculously glorified form of what is ordinarily called depreciation. Whereas a manufacturer may claim depreciation on a piece of machinery as a tax deduction only until he has deducted the original cost of the machine, until, that is, the machine is theoretically worthless from where an individual or corporate oil investor, for reasons that defy logical explanation, may go on claiming percentage depletion on a producing well indefinitely, even if this means that the original cost of the well has been recovered many times over. The oil depletion allowance is 27.5% a year, up to a maximum of half of the oil investor's net income. There are smaller allowances on other natural resources, such as 23% on uranium, 10% on coal, and 5% on oyster and clam shells, and the effect it has on the taxable income of an oil investor, especially when it is combined with the effects of other tax avoidance devices, is truly astonishing. For instance, over a recent 5-year period, one oilman had a net income of $14.33 million, on which he paid taxes of $80,000, or 0.6%. Unsurprisingly, the percentage depletion allowance is always under attack. But also unsurprisingly, it is defended with tigerish zeal. So tigerish that even President Kennedy's 1961 and 1963 proposals for tax revision, which taken together are generally considered the broadest program of tax reform ever put forward by a chief executive, did not venture to suggest its repeal. The usual argument is that the percentage depletion allowance is needed in order to compensate oilmen for the risks involved in speculative drilling, and thus ensure an adequate supply of oil for national use. But many people feel that this argument amounts to saying the depletion allowance is a necessary and desirable federal subsidy to the oil industry, and thereby scuttles itself, since granting subsidies to individual industries is hardly the proper task of the income tax. The 1964 Revenue Act does practically nothing to plug the loopholes, but it does make them somewhat less useful in that the drastic reduction of the basic rates on high incomes has probably led some high-bracket taxpayers simply to quit bothering with the less convenient or effective of the dodges. Insofar as the new bill reduces the disparity between the code's promises and its performance, that is, it represents a kind of adventitious reform. One way to cure all income tax evasion would be to repeal the income tax. However, quite apart from the sophistry, since 1964 happily somewhat lessened that the code embodies, it has certain discernible and disturbing characteristics that have not been changed and may be particularly hard to change in the future. Some of them have to do with its methods of allowing and disallowing deductions for travel and entertainment expenses by persons who are in business for themselves or by persons who are employed but are not reimbursed for their business expenses. Deductions that were estimated fairly recently at between $5 and $10 billion a year, with a resulting reduction in federal revenue of between $1 and $2 billion. The travel and entertainment problem, or the TEA problem, as it is customarily called, has been around a long time and has stubbornly resisted various attempts to solve it. One of the crucial points in TEA history occurred in 1930 when the courts ruled that the actor and songwriter George M. Cohan, and therefore anyone else, was entitled to deduct his business expenses on the basis of a reasonable estimate, even if he could not produce any proof of having paid that sum or even produce a detailed accounting. The Cohan Rule, as it came to be called, remained in effect for more than 3 decades, during which it was invoked every spring by thousands of businessmen as ritually as Muslims turned toward Mecca. Over those decades, estimated business deductions grew like kudzu vines as the estimators became bolder, with the result that the Cohan Rule and other flexible parts of the TA regulations were subjected to a series of attacks by Wood. Bills that would have virtually or entirely eliminated the Cohan Rule were introduced in Congress in 1950, one and again in 1959, only to be defeated. In one case, after an outcry that CB reform would mean the end of the Kentucky Derby, and in 1961 President Kennedy proposed legislation that not only would have swept aside the Cohan Rule, but by reducing to between $4 and $7 a day, the amount that a man could deduct for food and beverages would have all but put an end to the era of deductibility in American life. No such fundamental social change took place. Loud and long wails of anguish instantly arose from businessmen and also from hotels, restaurants, and nightclubs, and many of the Kennedy proposals were soon abandoned. Nevertheless, through a series of amendments to the code passed by Congress in 1962, and put into effect by a set of regulations issued by the Internal Revenue Service in 1963. They did lead to the abrogation of the Cohen Rule and the stipulation that, generally speaking, all business deductions, no matter how small, would thenceforward have to be substantiated by records, if not by actual receipts. Yet even a cursory look at the law as it has stood since then shows that the new reformed TESE rules fall somewhat short of the ideal, that in fact they are shot through with absurdities and underlaid by a kind of Philistinism. For travel to be deductible, it must be undertaken primarily for business rather than for pleasure, and it must be away from home. That is to say, not merely commuting. The away from home stipulation raises the question of where home is and leads to the concept of a taxed home, the place one must be away from in order to qualify for travel deductions. A businessman's tax home, no matter how many country houses, hunting lodges, and branch offices he may have, is the general area, not just the particular building, that is, of his principal place of employment. As a result, marriage partners who commute to work in two different cities have separate tax homes. But, fortunately, the Code continues to recognize their union to the extent of allowing them the tax advantages available to other married people. Although there have been tax marriages, the tax divorce still belongs to the future. As for entertainment, now that the writers of IRS regulations have been deprived of the Faraching-Cohen rule, they are forced to make distinctions of almost theological nicety, and the upshot of the distinctions is to put a direct premium on the habit, which some people have considered all too prevalent for many years anyhow, of talking business at all hours of the day and night and in all kinds of company. For example, deductions are granted for the entertainment of business associates at nightclubs, theaters, or concerts only if a substantial and bona fide business discussion takes place before, during, or after the entertainment. One is reluctant to picture the results if businessmen take to carrying on business discussions in great numbers during plays or concerts. On the other hand, a businessman who entertains another in a quiet business setting, such as a restaurant with no floor show, may claim a deduction even if little or no business is actually discussed, as long as the meeting has a business purpose. Generally speaking, the noisier and more confusing or distracting the setting, the more business talk there must be. The regulations specifically include cocktail parties in the noisy and distracting category, and accordingly require conspicuous amounts of business discussion before, during, after them, though. A meal served to a business associate at the host's home may be deductible with no such discussion at all. In the latter case, however, as the J. Key Lasser Tax Institute cautions in its popular guide Your Income Tax, you must be ready to prove that your motive was commercial rather than social. In other words, to be on the safe side, talk business anyhow. Hellerstein has written, henceforth taxmen will doubtless urge their clients to talk business at every turn, and will ask them to admonish their wives not to object to shop talk if they want to continue their accustomed style of living. Entertainment on an elaborate scale is discouraged in the post-1963 rules. But, as the Lasser booklet notes, perhaps a little jubilantly, Congress did not specifically put into law a provision barring lavish or extravagant entertainment. Instead, it decreed that a businessman may deduct depreciation and operating expenses on an entertainment facility, a yacht, a hunting lodge, a swimming pool, a bowling alley, or an airplane, for instance, provided he uses it more than half the time for business. In a booklet entitled Expense Accounts 1963, which is one of many publications for the guidance of tax advisors that are issued periodically by Commerce Clearinghouse, Inc., the rule was explained by means of the following example. A yacht is maintained for the entertainment of customers. It is used 25 of the time for relaxation. Since the yacht is used 75 of the time for business purposes, it is used primarily for the furtherance of the taxpayer's business and 75 of the maintenance expenses are deductible entertainment facility expenses. If the yacht had been used only 40 for business, no deduction would be allowed. The method by which the yachtsman is to measure business time and pleasure time is not prescribed. Presumably, time when the yacht is in dry dock or is in the water with only her crew aboard would count as neither, though it might be argued that the owner sometimes derives pleasure simply from watching her swing at anchor. The time to be apportioned, then, must be the time when he and some guests are aboard her, and perhaps his most efficient way of complying with the law would be to install 2 stopwatches, port and starboard, one to be kept running during business cruising and the other during pleasure cruising. Perhaps a favoring westerly might speed a social cruise home an hour early, or a September blow delay the last leg of a business cruise, and thus tip the season's business time above the crucial 50% figure. Well might the skipper pray for such timely wins, since the deductibility of his yacht could easily double his after-tax income for the year. In short, the law is nonsense. Some experts feel that the change in TAE regulations represents a gain for our society, because quite a few taxpayers who may have been inclined to fudge a bit under general provisions, like the Cohen rule, do not have the stomach or the heart to put down specific fraudulent items. But what has been gained in the way of compliance may have been lost in a certain debasement of our national life. Scarcely ever has any part of the tax law tended so energetically to compel the commercialization of social intercourse, or penalized so particularly the amateur spirit, which Richard Hofstadter declares in his book Anti-Intellectualism in American Life, characterized the founders of the Republic. Perhaps the greatest danger of all is that by claiming deductions for activities that are technically business but actually social, that is, by complying with the letter of the law, a man may cheapen his life in his own eyes. One might argue that the founders, if they were alive today, would scornfully decline to mingle the social and the commercial, the amateur and the professional, and would disdain to claim any but the most unmistakable expenses. But under the present tax laws, the question would be whether they could afford such a lordly overpayment of taxes, or should even be asked to make the choice. It has been maintained that